Good afternoon, everyone, and thanks for joining. My name is Janet Wright with Farm Service Agency's Outreach Office, and I have with me today Guido Vanderhoven, who's going to speak to the timberland owners about some tax considerations. At the end of his presentation, he's going to field questions, so please put your questions into the Q&A. And I just want to remind everyone that this presentation is being recorded. It will be posted to farmers.gov/taxes in approximately 2 weeks. Everyone who registered will receive an email when it has been posted. And with that, I will turn it over to Guido.
Thank you, Janet, and good afternoon, good morning, everyone who may be on. We see with the folks are still logging on. And today I've been asked to visit with you about some timber tax basics from landowners' perspective, as you can see on the title slide. This is a little bit about me, not that it's all that in a bag of chips, but I have worked in the tax area, the intersection of farm business management, landowners, and taxation for just about 45 years of my career. Do have a little bit of a disclaimer here. I've put this together at the behest of ruraltax.org and USDA, and I am trying to provide you the information as I understand it. And this is just a standard disclaimer, and that this work is being supported by the agreement number that you see listed there on the screen. Before I retired from NC State University, I was part of the group that did ruraltax.org, which is a rural tax education website, which is hosted most graciously by Utah State University. Colleagues and myself developed and managed materials under the National Farm Income Tax Committee. We've got information and topics there that you might find useful. Looking at, as you can see on some of the bullets here, disaster, weather losses, farm losses, hobby rules, self-employment tax, estate and gift tax, etc. A host of materials. Plus there's an updated version for tax management for rural owners, looking at folks that manage operations that can be small to mid-sized farms, and how these tax rules would apply. I would encourage you, if you're not familiar with that particular document, that you might want to avail yourself and go find that at ruraltax.org. Well, today's discussion is looking specifically at timber. And what we want to look at is defining what timber is and what timber is not in the context of the tax code, defining basis issues, looking at what basis is in the context of taxation. We also want to visit a little bit about timber activity. Is it a business or is it an investment? We'll spend some time there. And then we'll look at some reporting issues, particularly income. When timber is sold, how might we treat that? Under what context do we want to treat it on the expense side? And then we'll look at some other issues, looking at reforestation, and we'll look briefly at casualty losses. And then at the very end, we'll look at like-kind exchange and how that has changed with Tax Cuts and Jobs Act, which was passed in 2017, and then the one big beautiful bill made some of those provisions permanent as we are moving forward in time. So let's get kicked off. Let's look at timber and try to ask the question, what is timber? What is it from a tax perspective? Is the timber and the timberland a business in the context of tree farming? Or is it more of an investment? And here's where, for landowners, that does sometimes give a little bit of a friction point. How do I do that? And I think a little bit more of a friction point coming up when we look at some of the expenses because of some permanent changes in tax law. But generally, as we can see here on the screen, to be considered to be a business relative to timber sales, IRS generally will look at frequency of sales event. And they also look at something, and this is very important to consider. What is taxpayers' intent? What has been the taxpayers' intent over time? So one thing to look at is that if timber sales are infrequent, and that's roughly one timber sale ever so many years, then it's generally going to be treated as an investment return, a long-term investment return. But if there are frequent sales, 2 to 3 sales events that occur within, say, a 5-year period, looking at available case law, and then again, there's that parenthetical that you see on the screen, facts and circumstances are taken in total. What can we derive? What can we see? This may or may not be a sale event or number of sales that actually would make us think that we're in uh, a timber business. But generally, if we look at it very quickly and very broadly, an infrequent sale, one sale every so many years, it's going to be treated as an investment. And most folks that are rural landowners will probably fall in this particular category, and thus the reporting of that income will get favorable tax treatment under our code. Again, what is timber? Well, specifically, tax-wise, from a tax decision or a tax definition, we look at Internal Revenue Code section 1231B2, and in that, this is a listing of business assets. And so it would have a business connotation. Now, I was employed by NC State University prior to my retirement. And just broadly, if I look at the southeastern part of the United States, 60% of the southeast is covered in trees. And a lot of those trees, a lot of that land is held by private landowners, and they have the intent and they treat this as a long-term investment. But as you can see on that lower half of the screen, it's not always treated as such, because it could be that the timber that is being held if the taxpayer is indeed in the business. Now I've got that in quotations because in the business, and as we'll further the discussion in a little bit, we need to think about, is that truly the timber owner's intent? And additionally, it depends on what product we are talking about, what's coming out of these timberlands. If it is firewood, such as what you might see is in the center picture there at the lower part of the screen, you got a pile of split wood. This is going to be a product of the timber, and it is going to be treated very similar to corn, which is being planted just across the street here from where I live. It's going to be ordinary income and subject to self-employment tax, like a corn farmer or soybeans or anybody growing grapes or those kind of things. Pine straw. Now, this was in North Carolina, a pretty big size industry with longleaf pine. They would rake that up. And matter of fact, some longleaf pine plantations were planted not for timber production itself, but actually for pine straw. And they would rake it up and bale it, as you can see on the screen in the photo on the lower left-hand side. And this, again, is going to be a product of the trees, and it's going to be treated as ordinary income subject to self-employment tax. Now, when I say ordinary income, that's going to be earned income. This is what we materially participate in. We either ourselves or employees will go and harvest the pine straw in this case, or harvest the firewood, split it, and then make it available to the public for sale. And then there's also lighter wood, which is ordinary and subject to self-employment tax, and that's when you may go to, for example, Ace Hardware, and you can buy a box of sticks that you see actually lit there in the right-hand side, and it is very rich in pine resin, and starts fires in fireplaces or maybe in fire pits when you might want to have some time to have with grandchildren coming over, for example. So we need to define what that is, what is the product being sold. And there are just three examples that even though you're selling it and you're coming off of the land, it's going to be treated as if it was an annual crop similar to corn and soybeans. And if we have the sale of firewood, how would that be reported for income tax purposes? Here we just have an example. We've got Johnson. He owns several tracts of forest land. He harvests hardwood timber and he cuts the leftovers, the tops and the branches for firewood. And then he markets these in 8 to 10 piece bundles. And he does this by the rick or the cord as well. And these sales are going to be reported on Schedule F, which you can see here as an example at the bottom of the screen. This is profit or loss from farming. And you see you got Johnson Timber Grower, our taxpayer, assuming a sole proprietorship, he would use Johnson's social security number to report under. The crop in this case is going to be firewood. And notice that it's very similar to if we were growing corn or we're growing soybeans, we just put firewood in here and we have the code that looks at general forestry activities. He happens to use cash method of accounting, which is probably going to be the most common. Matter of fact, in my experience working with my former clients, about 98% of them use the cash method. But you can see here, sales line 2, there under part 1, farm income cash method, the sales of livestock, produce, grain, or other products. And the firewood then would fit in that other products category, as you can see there. And then we just report that $35,000 of that firewood sales in this particular example. There on line 2, he would obviously have expenses, diesel fuel, maybe some employee expenses for labor, other repairs, those kind of things, they would come off. But the gross amount that would be reported on line 2, and then we would have our allowable expenses that would come off on part 2 of Schedule F, and then whatever would be the net, obviously, would then be reported subject to ordinary income tax and self-employment taxes. So kind of thinking through the standing timber is going to be what we're going to deal with for the most part for the rest of this particular presentation and see what happens with it when it is cut. But I did want to make the example of either pine straw or firewood or lighter wood as being a timber product that would be sold. Now, when we move through and over the course of my 40 years where I did tax returns for clients, as well as did extension education, very similar to what I'm doing here today, we see that the issue when we have a timber sale is what's basis. What's the basis in the timber? And that would be referring to the cost basis that we would have, or it's going to be inherited, or it could be as a gift. And here we have a slide that kind of discusses those pieces. And looking at basis, that is the number one question. I would frequently say, farmer would come in and say, oh, I've got a sale of timber. I said, great, what's your basis? And then I get this kind of deer in the headlights look. Well, what are you talking about? I said, well, what's your cost? And we'd have to maybe go back and look at historic records. But when we look at the methodology under the tax code, how do we find that basis is acquired? Well, one is by purchase, you can see there, and that is that basis is equal to the price paid for timber as allocated to the purchase of the timber and the land. And we see that reference under Code Section 1012 listed there. We also have, and this is probably a very common situation, we have timber and timberland being acquired by a taxpayer through the process of inheritance. It could be a bequest coming to you a landowner from, mom or dad, or from granddad or grandmom, or whenever, however these might be. And so it gets stepped up to fair market value on the date of death. So if it had been acquired through inheritance and we have $100,000 of fair market value of timber, which has been determined by an appraisal, then that step up occurs on the date of death as fair market value, but the actual effective date of that step up in the hands now of the new owner is going to be the day after death date. Uh, just a very minor little piece. One could also, or the estate could also choose the alternate valuation date of 6 months after death. And this was provided, there's strength there under Code Section 2032, lowercase a. And also, there is provision within 1014 that if a sale occurs within this 6 month period, so from the date of death to within 6 months, then it's going to be deemed to be that sale value is going to be fair market value. So if we indeed inherited the property had timber that was mature enough and ready for harvest, and it was harvested, let's say, 4 months after our inheritance, or the estate then made the decision, because the estate hasn't been completely settled, or that we're going to sell it. And so they sell it, it gets harvested, loggers come in, cut it, and then we get a check for $100,000. Then that $100,000 is going to be the cost. It'll be reported as a $100,000 gross sale, and then the basis would be $100,000 as well. And so you'd have zero gain. Thus, that $100,000 of timber would not be subject to tax because it would have received that step up in basis. Oftentimes, between family members, we sometimes have transfer of property as a gift. And then this has then carryover basis from the donor. And here's where it gets a little bit difficult, when if mom or dad has transferred as part of an estate plan or as part of some kind of, here, we want you to have this, and then the new owner, the child, for example, would then have that, they harvest it, then their basis is going to be whatever mom and dad's basis is. And we may not have historical records, and these might not exist. And if we can't prove what basis is, then IRS's rulings basically say then basis is going to be zero, and the entire sale is going to be subject to gain and then be taxed as that gain. So it's important to have records, and it's best to establish those records while memories are relatively clear, and we'll see that in another example in just a few minutes. Transfer is also going to be carryover basis if it's part of a divorce where we have a divorce settlement, and that part of that is going to be a property settlement, and then we transfer over. And there could be a case where an individual might want to create a land or a timber holding entity, such as a limited liability company, and this company would then have this asset of the land and the standing timber as part of its asset base or as part of its capitalization, and that land and timber would then be the basis, would carry over from the individual creating that entity. If I had property and moved it over into an LLC, for example, then whatever I paid for that and whatever my allocation of the purchase price to the standing timber would be, that would become timber basis for me to deal with. Just as an iteration here, the biggest issue in all of this is basis, and there needs to be an allocation of basis between asset types and classes, such as land, timber, and improvements. And we have some of those. If you see this picture here, for example, on the lower left, well, I've got some, I can probably argue that we have timber land as an asset. We would have the hardwoods, the timber that's standing on that asset, on that timber land would be a second asset. Then you can see the cultivated field. That's a separate asset there, a separate class. So that would be our farmland. It could be that the farmland is $4,000 per acre of value. The timberland may have $1,500 of value per acre as timberland. And then the timber on it may have $4,000 of timber value if it's walnut or a maple or valuable oaks, for example, that could be there. You see in the foreground of that picture, we see some grass. So this could be pasture land. That's a different agricultural or land asset as well. And you see in the lower right, left-hand side, there it looks like to be a fence post. And that fence post could be marking where a drainage tile system is. So there could be assets that are subterranean that do have value that could be depreciated. And of course, there could be fences and wells and this sort of stuff. So again, the biggest issue is basis. And when property is acquired, then a listing of the asset types and the asset classes should be made and then allocate those assets and price respectively. Allocation, again, just to carry on, is just the proration of fair market value. If it's a purchase, which is hopefully based on the appraisal of the property, and I mentioned that just a moment ago, that IRS specifies in its rules, and some of those are listed there. Treasury Regulation 1.61-6A is specific that it should be done based on an appraisal of the property by a qualified individual. Code Section 1060, 1.338-8, and Treasury Regulation 1.1060-1 all have very similar language, but basically point to, we have an appraisal. There is a disinterested third party, if you will, that comes up and says, this is what the fair market value of this total property bundle, this basket of assets would be, and then how we would end up making that allocation. Obviously, if we bought the property below an appraised value, that would be a good deal for the taxpayer. If we bought the property for an above appraisal value price, that might not be a good deal, but land generally only comes up available for sale in a neighborhood once or twice a generation. And if it adjoins an individual's land, it might be worth it to pay a premium in order to get a bigger piece of property or a more efficient piece of property to be operated if we are farming or if we've got timber property that we are looking at. So these are generally the rules. We want to prorate. Well, how do we do that? And again, we have that. We've got these acquisitions, and there is the requirement that the taxpayer and their tax practitioner, whether it be a CPA or an enrolled agent, they do have to consider this if more than one asset was acquired in the transaction, and we just looked at those. Now, for standing timber, a consulting forester might be helpful to come in and be hired to do a timber cruise and evaluate what this timber would be worth relative to the day of purchase. We've already looked at this particular picture again, and I just want to reiterate, if based on that conversation just a moment ago, that we can see that there are different assets and asset classes, and that's what we really need to kind of separate out. What did we pay for this property in total? And then how does that work out? And here I want to work through an example of that. So here we've got our good neighbor, Fraser Fur, and he's paid $410,000 for land that has standing timber, and there are other assets. And he does go ahead and have an appraisal performed. And he determines that he made a good buy, as you can see there in quotations, because per the appraisal, the fair market value is determined to be $490,000. So in that regard, his net worth has increased on paper at least by $80,000. But he has paid. His cost basis in all of this property is $410,000. That's what he wrote the check for. And that's what we're going to allocate across these assets. And here's kind of his asset allocation. And this is the process that tax practitioners would use, or you would use yourself if you are actually indeed going through and saying, okay, this is what I've got. There was a home on the property. It had a fair market value of $100,000. Shop, timber land, that's the land itself, the dirt, the farmland. There's the homestead land, that's the 1 acre or so that the house sits on. And then you notice that there's some merchantable timber, $125,000 of value, and there's some young timber, $10,000, and that totals up, if I've done my math correctly, $490,000. Then what you end up doing is as you can see in that second column from the right, this is going to be the percentage of fair market value. And simply you would take, in the case of the home, $100,000 divided by 490,000, that gets us 20.4082%. And IRS really wants us to go out to four decimal points. So that's why all of these have got 4 decimal points. Then what we have is, well, the fair market value was 490,000, but we only paid, in this case, Frazier paid $410,000. So we take the percentage of fair market value, the 20.4082% in the case of the home, times 410,000. So the home's basis, as you can see there now in the right-hand column, is going to be $83,673. And that's done for each identified class or individual asset. So the timber land, its land, the dirt is going to have, in this case, $54,387.76, or we round it up to $388, for example. The timber is going to be 125,000 fair market value multiplied by the percentage of fair market value, which you see is 25.5102%. So that means that our timber basis is going to be $104,591. And I've gone all to show pennies, but in these, IRS would allow you to round to the nearest dollar. So the house in the example would be 83,673 because 47 cents is below 50. And then in the case of the timber, it would round up to $104,592, but I've left everything in there. So when we do all of that adding and allocation on these various different assets, you see we end up with $410,000 in that lower right-hand box. So thus we have allocated the complete basis of our purchase price, the $410,000, across these 7 different assets that we have here, the home, the shop, the barn, etc. Once we've done this, what good is it? Well, what we want to ask is, are some of these assets depreciable against a business or an investment property, or are they non-depreciable? So if we were using the shop and barn in our investment or in our trade or business, then it has allocated basis of $20,918. It's going to be depreciable, and it would be, if this is in a farming business and tree farming and regular farming, if you would be that this would be allowed to be depreciated over a 20-year lifespan. So yes, we would have to do that. The home, It has an allocated basis of $83,673. If Frazier is going to use this as his residence, it's not eligible for depreciation. But if he sells that house off sometime in the future, it is going to be eligible for the Code Section 121 exclusion, where we can exclude gain up to $250,000 if Frazier is single, or $500,000 if Frazier is married and filing a joint return with his spouse. Or if he decides to rent it out as a residential rental, he can recover it over 27 and a half years using straight line depreciation. Or if he is saying, hey, I have a nice house myself. I don't need this house, but my farm manager or my farm hand does, can offer that as a house as part of the compensation package. Then it becomes a farm building and would be eligible for a 20-year recovery period using 150% declining balance. And it's also going to be eligible for bonus depreciation, just like the shop and barn would be eligible for bonus depreciation. So a tax planning thing in this particular example, there's a lot of things to think about as we move through. So obviously, it's best to make these allocations as soon as possible after the sale or after the inheritance, while memories are fresh and the market is unchanged and we can find valuation. Now, off and on, we see that there's proposed legislation in Congress to deal with the federal deficit, to deal with the national debt, and there have been proposals to repeal step up in basis at the date of death, and that would require carryover basis. And then if this becomes the case, then basis records carrying from one owner to the next owner, if it's within the family and there's gifting and there's inheritance, that's going to become very, very important. Now, many pundits and myself included, I don't think that this is going to really happen, although, never say what Congress is going to do or what Congress isn't going to do. And the reason I say that is that step up in basis has been available to American taxpayers for over 100 years. But again, as that last little phrase there on this particular slide, no one really knows what's going to happen, but just be aware. But I think the takeaway point from this discussion here is that with a purchase, and if there are multiple assets within that purchase, it's best to allocate the cost, either the fair market value from inheritance or the fair market value from a purchase price, as illustrated in the example with Frazier, to go ahead and allocate to those assets. Now, what happens if the landowner doesn't have basis? And this is quite often the case. And hopefully you might be going to your accountant or your tax practitioner. If you use a tax practitioner and say, I'm thinking about selling some timber, and you do this beforehand, because IRS does allow for a back cruise if the timber is still standing and is attached to the roots. In other words, it's attached to the land. And as I mentioned just a few moments ago, if the landowner doesn't have or can't prove basis, then the presumption is basis is going to be zero. And here we go back with a back cruise. Well, what is a back cruise? And here's the Treasury Regulation 1.611.3F provides for that allowance. Consulting forester conducts a statistical survey looking at the species of trees, the density, and the size. The forester counts the rings from statistically selected trees. He uses a wood boring instrument at breast height, which is about 4 feet above the ground. And then he applies historic timber prices to the volume of those trees. And then he can determine the timber value and then the basis of that timber. However, we can't zero out the land value. The land value has to be there. And if the trees have already been cut, then generally this back cruise can't be applied because it doesn't fit. Yes, we can count the rings from the stump, but the stump is not 4 feet above the ground, and that's one of the qualifications. So there is a process that's allowed that goes back into history because we can count the rings, and that process is called a back cruise. We've talked about inheritance. Basis is acquired at fair market value. Remember that step up occurs on the date after death in the hands of the one who inherits it. And as noted previously, you really should have a qualified appraisal to establish what that is. Now, there are some people that will ask me, well, what about ad valorem appraisals for property tax purposes? They're not the best. It is an appraisal, yes, but they are for property tax purposes. And in cases, how current is that? Some jurisdictions require an appraisal annually. Others say over a period of 8 years, it needs to be reappraised. So it just depends on what happens with the market. Are you at the top of the market when that was done or not? So we need to think through what that value is for. And here we see in the Treasury regulations cited 1.170 cap A-17, that gives us the definition for who a qualified appraiser is, as well as what a qualified appraisal contains. And it kind of goes through all that discussion that we've just had and looked at. You got the parts and pieces. Do it when you get it. Now, I do want to make you aware that there is special use valuation. Rural landowners might be subject to estate and gift tax. They have 2032A. They could reduce the value of this qualifying real property. For 2026, each one of us has a $15 million tax-free estate that we can transfer, $30 million for married individuals. 2032A for this year does reduce potentially the total tax for qualifying property by $584,000, as you can see there on the screen. And that essentially gives us almost $1.5 million reduction. Here we have an example how that would work. So Yolanda inherits land and standing timber. The estate elects to use 2032A and reduces the value in this particular case by the maximum, 1.46 million, bringing Yolanda's grandmother's estate to the 2026 exclusion amount of 15 million, and in this case would reduce the estate tax by $584,000. That's no small change. So it needs to be held by a qualifying heir. Yolanda, being a granddaughter, would be. It has to be continually used in the special use. So that's for growing timber for 10 years. Now note the highlight. A timber harvest violates special use. It's a quirk in the law. It doesn't really make sense. But what happens is if Yolanda inherits this timberland and then within the 10-year period from the date of grandmother's death and they make that election and harvest that timber, it's going to trigger the recapture of the deferred taxes, in this case $584,000 plus interest, and whatever the interest would be is going to be generally going to be the applicable federal rates over this 10-year period of time. And it can sit up to the table and say, So it's very important to be able to count 10 years. And I don't mean that to be cheeky, but I am aware of a situation in North Carolina where I worked where there was a miscalculation by only a few months, and it triggered this recapture, and that was a very significant amount of money that nobody was planning on paying. Gifts, again, they can transfer with land. Just be aware that the annual gift exclusion for 2026 is $19,000. As we've said, we need to think about what the basis is. It's going to be the adjusted basis coming over. There are other factors that could come in. If the gift happens to have been made prior to 1977, then any gift tax that was paid will get added to basis. If it's after 1976, then its basis is going to be only by tax paid, but in a limited amount. And if the fair market value of the property was less than the donor's basis, then there is a potential special loss limit that applies, and that goes a little bit beyond the scope of this particular discussion. You may be familiar with Form T and timber basis calculations. Now, a landowner who claims the deduction for timber depletion or depreciation of any improvements or makes the election to file a 631A, they have to use Form T. But as a practical matter, and I'm assuming that most folks on the call are not going to be in the business, that landowners holding timber as a long-term investment don't need to file Form T. I'm just making that available. But Form T is a useful tool to track basis as timber grows and moves from being pre-merchantable timber to pulpwood to chip and saw to logs and poles, because as trees age, they grow up. The question now we're going to switch here is looking at taxpayers and tax professionals. We need to be clear in that communication of what is taxpayers' intent. Are they in the business or are they an investor? What are the fact pattern and how does that measure? Here's an example, and this is probably one we want to look at a little bit. Southern Pine purchases 50 acres of land with standing young timber back in 1990. And his intent, and the intent is here highlighted, was to hold this as an investment to finance his children's college tuition. He sells the timber for $150,000 in 2025. $10,000 was allocated to timber as basis way back in 1990. So he's got $140,000 long-term capital gain because his intent was as an investment. Expect to receive a 1099-S, and this is what it would look like. So Fastest Can Be Logging was the logging company. He issued a transfer name to Southern Pine, $150,000, and this was done in the year. Southern Pine then is going to report that generally on his Schedule D, as you can see here, and he's got $150,000 of proceeds. That was the sale price. Cost is going to be $10,000, so he has $140,000 worth of gain, and that's going to be treated as net long-term capital gain and will be preferentially treated. If he remains, based on what other things come on the tax return below the top level of the 12% tax bracket, he probably won't have any tax to pay. He may have some losses that he's going to be reporting, but we'll see. So just remember, one, expect a 1099-S. And for investors, if it is short term, so the timber was held for less than 1 year, you're going to have another form, which is Form 8949. Basically, it just kind of brings all of these things together. Part 1 is going to be, as you can see there in the green list, less than a year. Part 2 is for long term, and the blue is for long term. And so, but for Part 1, it's going to be for short term. Part 2, as I just mentioned, is going to be for long term. Now, if there's a gift or an inheritance, the donor's holding period is going to attach to the donee. And for inheritance, the presumption of the law is that anything that is inherited is going to be long-term. So these are very taxpayer-friendly type of positions. But again, we would want to look at that and see what that holding period actually was. So for most folks, either they're getting land as a gift, timber as a gift, or inheriting it, it's going to be long-term, so it'll be reported on Part 2 of Form 8949. That net result then gets transferred over to Schedule D, just like I illustrated. I did take a little bit of a shortcut, but it would go to Schedule D and get the capital gain. And here, just again, gets long-term capital gain, short-term gets ordinary treatment, and I don't think that many folks would be subject to ordinary, but timber sales are subject to the net, that's the net investment income tax. It's a 3.8% surtax above certain thresholds. If you're married, filing a joint return, that's $250,000. And if you're single, it's $200,000. Those are statutorily fixed. They do not increase due to inflation. Let's look just briefly, because we're about about 60% done here, and we're doing quite all right on time. Looking at timber activity, is it a trade or is it a business? And generally, as I mentioned at the beginning of this, that we have the frequency of sales or transactions. And so here we look at Code Section 162, and we also have the court case, the Commissioner v. Grotzinger. And Grotzinger's case looked at, and this was in the rulings from the tax court, that a business activity is conducted with regularity, continuity, and a profit motive. Those are in bold, but there's also that frequency of transactions. And remember, we talked about having, 2 to 3 timber transactions within a period of 5 years. In the context of timber, this is what's looking at and what the individuals think that would be more business-like. So timber investments, by contrast, are going to be infrequent. And again, as we just covered, investors need to be aware of the net investment income tax, or the NIT, as we talk about it in the tax language. So does what you are doing fit more investor or trader business? And being treated as a trader business, it does make it a little interesting, because we have something under Code Section 199 Cap A, the qualified business income deduction, the QBID. It does make life interesting. The issue is timber generally gets capital gains treatment, even if you're in the business. And this eliminates the QBID, as capital gains is being taxed at a preferential income tax rate, either 0%, 15%, or 20%. And the facts and circumstances of the case of the taxpayer is what's going to determine the outcome of the landowner's tax rates. My assumption is that many folks in the call are landowners that treat timber as an long-term investment, so this would not apply. However, if there are folks that are in the business of timber production, they might want to consider making a Code Section 631A election to capture most, if not all, of the gain as a capital gain. And this was a change in tax law under Public Law 108-357, which was signed by President George W. Bush at that time on October 22nd, 2004. And it's a several step situation. I'll just briefly describe it right here on this slide. Step 1 is to basically sell to oneself on January 1 of the year, and you're going to report that deemed sale on Part 1 of the IRS Form 4797, which is the sale of a business asset. Remember that we defined that timber was a business asset under 1232 in one of the first slides. Then we're going to do, in our record books, in our record keeping system, we're going to do a mark-to-market book transaction, treating that as a sale. We're going to net all 1231 transactions. Net gains are going to be capital. Net losses are going to be ordinary. And so once that's done, then you go to step 2, which is then going to be reporting the actual sale, so the real dollars. That's going to be reported on Schedule F if we're a sole proprietor, with line 1 um, going to be that sale, and then the basis from 47.97, the January 1 sale date, that proxy or that deemed sale is going to be on line 2. And then the net gain between those two is going to be on line 1C of Schedule F, subject to ordinary and SE taxation, very similar to the discussion that you saw in the example of Johnson selling firewood. Then step 3 is going to be on that Schedule F. We're going to be able to deduct the sales expenses and any timber harvest costs, which oftentimes end up being a loss. So we have gotten the tax benefit of a majority being treated as a capital gain on 47.97, and then we have an ordinary loss from commissions if we've had to construct temporary logging roads, temporary culverts or bridges, and if there's any boundary survey costs, any of those kind of things, that could actually consume whatever is the difference here on that step 2. So it is something to think about if we are in the business. So we just finished up looking at the reporting of income. Now what we want to look at is some of these expenses that are incurred of the timber activity and whether the landowner can actually deduct these timber expenses in the current tax year is going to be dependent on several factors. Are we acting as an investor, or are we acting as an active in material trade or business? And do passive activity law rules actually apply in this particular case? Now, for investors, and most folks I think on the call are going to be treated as investors, the one big beautiful bill, or the OBBB, which was passed in 2025, permanently eliminates the itemized miscellaneous deductions that were subject to the 2% floor. This was originally introduced in the Tax Cuts and Jobs Act back in 2017, but has now been made permanent. And what that means is for landowners treating timber as an investment, they're not going to be able to deduct many of their expenses, and they have to capitalize those costs into the timber basis. In other words, just add it to that timber basis, and when that timber is harvested, then they'll recover those expenses against that sale. If, however, timber activity rises to a trade or business, then operating costs and carrying charges are generally going to be treated as ordinary and necessary business deductions, and we're going to be able to deduct them. But there is a catch, and that is that second bullet. If there are no sales in the current year, then the carrying charges cannot be deducted. So what are carrying charges? Carrying charges are going to be property taxes, insurance, and any interest paid on loans related to the timber. So if we had to borrow money for timber, did we allocate that to the timber? And Treasury Regulation 1.266, as you can see there, allows for capitalizing the carrying charges into the timber account. We also have development costs of timber. So we have to capitalize those development costs into the timber account. So these would be silviculture practices. Are we doing some non-commercial thinning of the tree stands to encourage better product at the end? Are we doing some timber stand improvement? In other words, are we applying fertilizer or are we applying herbicides? And then whatever we make this election, it's going to remain in effect until that development is completed. And it could be that, for example, in the Southeast, if we're putting in a new pine plantation after a previous harvest, then we may need to do some of this timber stand improvement, herbicides, and make that election over a period of 4, 5, maybe 6 years as that stand gets developed. If, however, we're in a material trade or business of tree farming, and we need to purchase some equipment or machinery. So maybe a tractor or a dozer or a backhoe or a feller buncher or whatever what machinery we may be buying, we're going to be able to maybe use Section 179 expensing subject to some limitations. Bonus depreciation, as we find it under Code Section 168K, this is going to be allowed 100% in 2025 and future years. This was made permanent under the One Big Beautiful Bill. We also have maker's depreciation, which is going to be, if it's new piece of equipment, we'll get 5 years, 200% declining balance to depreciate it out. If it's a used piece of equipment, it's going to be 7 years over 200%. That doesn't quite make sense to me sometimes, but that's again the way the rules are written. The election to use 150% declining balance or straight line can be used, or we can elect to use the alternate depreciation system with a 10-year life for all this equipment instead of the 5 or the 7. And these are tax planning, tax management opportunities that can be made. And this again is looking at the active and material trade or business of tree farming. If we're an investor, and we still have to buy some of this, Section 179 is going to be generally disallowed. Okay, so that's the one difference between the two. But bonus depreciation is going to be 100% again in 2025 and future years, allowed for income producing property, which would be investment. And then the same maker's rules for depreciation would apply to the landowner. So if we're buying equipment, we still get to depreciate them. We still get that to pull that stuff out. So we get it. Passive loss rules. Now here's if the timber trader business is going to be classified as passive, it could be subject to Code Section 469 rules. And these regulations, there are 7 specific material participation options, but 6 of those are relevant to timber, and they are listed here on the screen. And this is trying to get us out of passive loss rules. So if the landowner's activity was greater than 500 hours annually, if that's not the case, but the landowner's activity is substantially all the activity that was done, or the landowner's activity was greater than 100 hours and as much as anybody else, because we can oftentimes do some things through agency. We have an agent act on our behalf, forester, for example. If the timber is a significant activity and all the significant activity was 500 hours or more, if the landowner had actually materially participated in 5 of the last 10 years, or if the landowner participated more than 100 hours, and then based on the facts and circumstances, this is going to be treated as a materially participating business. So these rules, and there's some questions that need to be addressed and say, hey, is this passive or not? Here's just an example. We've got Jose owns 200 acres of hardwood timber. He spent less than 10 hours in the timber activity, and he's paid $5,500 in various costs. He has no income. So under 469 definitions, what we just saw, this is a passive activity, and these expenses are going to be suspended and not deducted in the current year. And they're going to just have to keep track of those until we have a material participating year, or we have a timber sale and be able to deduct that against the cost or the gain of that timber sale rather. Let's look at expenses as an investment. Okay, so some of those in the front end we looked at, were they business, and now we want to look at the investment side. Even though, as I said, the One Big Beautiful Bill eliminated certain miscellaneous deductions, there are other code sections that might allow for a deduction. And making the choice to capitalize those might be really good. And here we have a case that we have $3,500 of herbicide costs and $2,000 of controlled burning costs. And in this particular case, we can't deduct those on as a miscellaneous itemized deduction, but what we can do is move them into and capitalize them into the timber account or the timber basis account. And that way, sometime in the future, we'll be able to recover that expense. There are other deductions that are directly allowed, and one of those is property taxes as a personal itemized deduction under Code Section 164. And then if we have interest on timber related loans, that's going to be allowed under Code Section 163 as separate items that can do it. And here we've got our buddy Douglas Fir. He has property tax and interest. So he's paid $5,500 of property taxes on timberland, $9,500 of property taxes on his principal residence. He has $10,000 of interest on his timberland loan, and he has $2,500 of investment income, dividends, and long-term capital gains. So is he going to be regarded? Well, we have to kind of look at that and say, yeah. But under the one big beautiful bill, Douglas is going to be limited to $40,000 of state and local taxes, but he's paid $15,000 on the land and on his principal. So he's going to be able to deduct those if he itemizes. And that's the key. He's going to have to itemize. But look at the investment relative to his interest. He's got $2,500 of investment income that we saw on the previous slide. He paid $10,000 worth of interest. He can deduct $2,500 of that investment income, but he can't deduct the $7,500 worth of interest. And so he may have to end up capitalizing that or losing that. And so here we have that. He can elect to capitalize to $10,000 of interest to finance the timberland if he wants to. This increases his timber basis by $10,000 in this whole thing, which could be recovered in a subsequent timber sale. So his choice is, do I lose the $7,500? Or do I say, no, I'm going to take a long view of this and I'm going to deduct or capitalize to $10,000 of interest paid. It's not perfect, as you see there at that last bullet, but we're not losing that forever either. And here's an argument to be made that we say, hey, it is real. If timber is going to be a significant portion of maybe your income stream coming in, you would want to have somebody that could have an understanding of some of these tax rules. And hopefully this slide deck will be available to you and you can take it to your tax preparer and say, hey, because I'm referencing a lot of the tax code, and you can explain to your tax preparer, well, this is what I did, or this is what I want to do. What's the best tax efficient way for us to move forward? So we're revisiting this a little bit, and that is timber income going to be qualified for the 20% qualified business income deduction, or the QBID? And just as a reminder, timber sales won't qualify generally because they're going to be treated as capital gains type income, and that has a preferential tax rate anyway at 0, 15, or 20%. And so it doesn't qualify. So if you had $100,000 worth of timber income and you're hoping to get, $20,000 of that as a deduction, you're not going to get that because of the preferential treatment as capital gain. Also, if we're an investor, we may be subject to the NIT, as previously mentioned, and that's going to be dependent upon what is going to be your threshold, either $250,000 or $200,000. One item that we do need to think about is reforestation expenses. And this is something that investor landowners do not want to miss, particularly if they're in the Southeast and they've just harvested some loblolly pine or some shortleaf pine or some yellow pine, and they're reorganizing and preparing the land. So for investor landowners or even in the business, those who do reforest, not that we're beginning to afforest, create, if we plant timber in a pasture, that would not qualify because that's not going to be reforestation. That's going to be afforestation. But if we are going to reforest, so we're going to plant seedlings after a harvest, then we're going to be able to deduct up to $10,000 of reforestation expenses per unique tract of timber. And then anything above $10,000 is going to be amortized over 84 months. So basically, after 7 years, you're going to recover the reforestation costs that were incurred on this property. Now, this gives landowners a planning opportunity to do that. And remember, what you might want to do is say, hey, if I'm going to spend, let's say, $18,000 in reforestation, just as a number, maybe I want to do that, $10,000 of that in December, and then $9,000 of that in January of the subsequent year, because this is an annual opportunity, and you get $10,000 in year one, and you'll get $8,000 in year two as a reforestation, as opposed to if we end up doing $18,000 in year one, you get only $10,000, and then the remaining $8,000 has to be amortized over 84 months, and you'll get to recover that $8,000 over the next 7 years. The deduction to report this on the tax return is going to be taken on Schedule 1, line 24 Delta, Form 1040, and you can see that I have illustrated how that looks on line 24D. I've got $10,000 there in that center column, and there is that line for reforestation, amortization, and expenses. Now, just as a note, Treasury has not amended the tax regulation 1.194-1 to reflect these changes that were made both in Public Law 109-135 and as Public Law 108-357. So they're from 2004 and 2005. Those issues aren't there. So the law allows it, but if you look at the Treasury, they haven't updated the regulations for that. And that may be, for a tax nerd like myself that worries about that, but I do want you to be aware of that. One thing to think about is reforestation recapture. This might be something that gets missed on a tax return. The reforestation expenses are going to be recovered if a sale occurs under Code Section 194, and they're going to be recaptured and they're going to be treated as ordinary income. And this is specific under Code Section 1245B7 if this sale happens within 10 years of reforestation. Then you're going to have to recompute the basis, but for the investor, the sale would go straight to Schedule D, but if reforestation had been taken on previous tax returns, then you're going to look at 4797 used for the recapture part on Part 2, and it's going to be recaptured being taxed as ordinary income. And in this case, recapture is separate under what we refer to in the tax lingo as a tax benefit rule. You were able to deduct the reforestation expenses in the previous year. Now you need to pay the price. The nice thing is if the sale is beyond 10 years, so if reforestation occurred in 2011 and you sold the property in 2026, that is obviously greater than 10 years, you don't have to worry about the recapture. You're outside of that 10-year period. Looking at casualty losses, And this is something that we think about, and I've got here Hurricane Helene, for those that might remember that hurricane. But we need to remember the general rule for a casualty loss, regardless of whether it is business or investment, uh, it's going to be the lesser of basis or the decrease in fair market value. And that we get that guidance from code section either 165 or in code section 112, but most of it's going to be in code section 165. So the casualty gain is often going to be the case because of low to zero basis in timber if there's a salvage operation. And so this, and I've had to deal with this in North Carolina quite a bit, and it's sometimes very difficult to get the taxpayer and the landowner to understand, yes, you've had an economic loss. I'm not arguing that. You've had an economic loss. So we had $100,000 worth of timber. Hurricane came through, knocked it all down. We're harvesting it early because it may be in year 28, 29 of the rotation, and generally we're harvesting in year 36 to 38. So we're missing out on the last 10 years of real growth, but it does have some value. Well, if we have no basis or we have low basis, then whatever we sell is going to be a gain. But we can't say, oh, well, we sold for $40,000, but we would have sold in 10 years for $100,000. I'm going to take the $60,000 as loss. No, that doesn't work. It doesn't work that way. We do have, however, that a casualty does qualify for a 1033 involuntary conversion. And so the gain can be deferred by purchase of like-kind property within 2 years of that casualty. And you can see the rev ruling there, 80.175, that gives us some of that guidance. So how does that work? Well, in my example, we do a salvage operation, we get $40,000. We don't want to pay tax on it. Can we buy another piece of property, some timberland that's like kind, either withstanding timber or bare ground that is going to go back into timber? Can we go back into that and then have that? Yeah, we can buy it. Pay $45,000 for it. We defer $40,000 worth of gain. We now have $5,000 worth of basis in the new property. We reforest, get to deduct the reforestation. We have no tax consequence on that $40,000 until sometime in the future when that new piece of property has timber. So it's an opportunity. It's something to talk to professional tax guidance for that. One question that I got quite a bit, and this is the final topic in today's discussion, is what about like-kind exchange? Well, prior to Tax Cuts and Jobs Act, and now with the one big beautiful bill, how it's all made things permanent, that the definition of real property has become much clearer. Specifically, when you look at, and this is pulled straight out of the language of the law, if it's unsevered natural products of the land, including growing crops, plants, and timber, mines, wells, and other natural deposits are going to be treated as real property for the purpose of this section. The operative word here is unsevered, so it's still attached. Natural products and deposits such as crops, timber, water, ores, minerals cease to be real property when they are severed, extracted, or removed from the land. So in the case of timber, that chainsaw comes in and cuts it off. It goes from being real property when it's standing to being personal property when it's on the truck. So just a couple of cases, like-kind exchange, timberland versus timber. No. Timberland for other real property, yeah, that will stand. Yes, quality is not an issue. So it can be timberland for a beachfront property that you're going to rent. It can be timberland with standing timber, as you see here in the photograph, that's going to be off for bare farmland, whatever. Standing timber attached to land is real property for property tax purposes, as well as that IRS clarified it in these final regulations that we just discussed. It's real property. Now, some people will go back to a 1953 case law. This is the Oregon Lumber Company v. the Commissioner, and a cutting contract is not like kind. And just to put a fine point on it, logs on the truck are not real property. The chainsaw converted it to personal property, and we saw that in the language of the law in the previous slide, that being severed, it no longer is real property. Some folks may also recall another court case, Smalley v. the Commissioner. This was about 15 or 16 years ago now. At that time, it was a very, very weak maybe, but now it is a definite hard no, because if we're severing it, the new definitions and in the fact pattern of Smalley, they're going to have the outcome that that is not going to be like kind property. So I am aware that sometimes things get done on tax returns that aren't exactly following the law, but we now have a clear definition. Standing timber, just like what we're seeing in this picture here, is going to be treated as real property. But once it's cut on the truck, it's personal property, and that sale will not qualify for like kind exchange if we go and buy other timber property. So just be aware of that. Well, that gets us here to the end. I think I've got just a few moments left for any questions. And so I'm going to let Janet help us through that if there are any questions or any clarifications that folks might have.
So right now, Guido, we only have one. So for anyone who has any questions, if you could go ahead and drop them in the Q&A box while Guido answers this one, and it is, can basis increase from management costs?
Basis can increase from management costs if they are not deducted in the course of business. So if it's an investor, it's one of those operative charges. If there's no sale, there's no timber sale against which those costs could be done, then they could be capitalized into the timber basis and then recovered at some subsequent time. Good records obviously would be encouraged to be had.
Okay, no other questions have come in. And so I think, Guido, you've done it.
Okay, well, thank you much. And I hope that this has been useful. I know it might be a little bit pedantic somewhat looking at all the tax codes, but that's the area in which some of this stuff is really where the rubber meets the road. But I hope that the discussion and I hope that the examples are useful and that you can see how you might want to apply that in your life.
One more just popped in at the last minute. Can
Okay.
growth tables be used instead of increment boring?
The regulation speaks to a bore for it, and I'm assuming that this is for determining basis in a back cruise. And in the back cruise, that methodology requires a bore from a statistical sample of trees. So I would answer that as no.
Okay.